Hi, this is Shane with The Rational Trader, and this is the weekly update on April 21st. We're going to talk today about an analysis related to the increase in volatility that we've seen, and even as it's sort of quieted down here, what the impact is on model building and just the daily choices we have to make about how to trade that day. So as long as it's going to stay volatile like this, even though it's quieter than it was, we still need to make some choices every day. It's not like last year where you could it's not like last year where you could just look at it on Sunday and then just trade that the rest of the week. Right now, pretty much every morning you're having to decide based upon the expectation of that day's volatility what you should do. So I've got some results I want to share with you of an analysis I did, the conclusions I drew from that analysis, and then the actions I'm taking as a result of that. Okay, so coming into Monday, I have a very clear understanding of what I'm going to do every day. We're also going to talk about an update to the system that is in testing, where you can define whatever strategy you want that then calls for a prediction when you define it. Okay, so user-defined behaviors instead of just the behaviors that I have defined. Okay, so let's start with the volatility analysis. And I think the key thing here is that we know that the markets have gotten volatile, and we can see that when we look at the daily chart. There's a very big, let me move this out of the way. There's a huge spike right here where the markets just got crazy. And where I got sort of fooled, I think, is that we were dealing with this issue, and then it comes back down and is leveling off, and my view in here was like, okay, things are headed back to normal, and same thing here. Okay, things are headed back to normal, but this level right here, I need a different color. This level is by no means normal. Okay, that level is way above what I would call sort of normal behavior in the markets, and so it needs a different response. But I've been treating this more like, okay, we've been trading in normal times, and now it's just a little more volatile than it was. And when I look back at the daily videos and I think back on my interactions, I realized that I could start to see that correctly, but we aren't back to normal yet, and we aren't even back to a point where it's what I would call a normal increase in volatility. Right, we're not there yet. We might be coming down back to what we would call normal, and the previous sets of rules that we would use to approach trading may start to apply, but until then we need to do something different, because this is basically, and when you're looking at this pink line here, this magenta line here, this is like twice as volatile as normal. All right, so we have to deal with that. All right, and so what I did is I went and looked at replays using new models, and I took a lot of input I got from members who are trading, and some of you are doing quite well actually. And so I got to thinking about that, and I put together an analysis that kind of brings all that information together. So there's a lot of data on this screen. We're going to walk through it slowly so that you can parse it and understand how I came to the conclusions that I came to. So let's start with what we see over here. This is sort of the raw data. All right, and what this is an analysis of the overnight range versus 2 different strategies to trade that day. Okay, now before, actually, I went a little too quickly because the first thing I realized, and I don't have that data to show you, but the first thing I realized when I was looking at this chart and looking at results is that when the market is like this, the way I've been building the model is just fine. Okay. So the models we use a 30-tick target. We basically go, give me a target that's 3 times the height of the bar that I'm using. And that tests out fine. It trades fine. It replays wonderfully. But when we get into the super volatile time, what we discover is that, okay, well, you're actually much better off if you push that target out. And so the first thing that I'm doing is looking at this daily chart and assessing, okay, well, where are we in terms of just the overall volatility of the market? And if it's above a certain level, and I'm building the model that is uses targets that are further out, okay. And if we can get back down to, if we can get back down to this level, then I'll start making the model more like I was towards the end of last year, or the beginning of this year. Okay, so if we can get back down to volatility at the yellow line level, then or ranges at the yellow line level, then I'll make the models that way. But until then, we need a model that recognizes that the markets are making bigger moves. All right, so with that in mind, what this shows is using the model that uses a target that's further out. What happens when we look at how it performs? All right, so this model was built using data through February 2nd. All right, so it excludes this craziness here, the craziness in this period. It actually excludes everything from here forward, okay, for the moment. All right, and there was discussions about that during the week, because when a market gets that volatile, it's basically random, and we don't want to corrupt our model with random data. Okay, so using data through the second with a target that's further out, what this shows is column B is the overnight range, A is the date. All right. The overnight range here, this is when I walk in the morning and I look at, okay, well, what was last night's range? All right, so when I have to make that decision at the beginning of the day. All right, and then C, column C here, is, well, what was the overnight range in points for the this is all for the NASDAQ. Okay, and the way that this column C is colored is that if it was less than 40 points, it's white, of which there was only 1 in the last 28 trading days. If it's yellow, then it's between 40 and 60. If it's blue, it's between 60 and 100. And if it's red, it's over 100. Okay, so we broke it up into 4 categories, or really basically 3 categories. Below 60, between 60 and 100, and over 100. Okay, and then column D is, okay, well, results of replays with, for the M contract from March 9th through the 18th of April. And column D is using just what I've been using, moderate, aggressive, plus breaks. And then column E is just breaks only. Okay, and I chose breaks only because what I was getting from other members is that what they did is, as the volatility went up, they just dropped to breaks only and actually did pretty good. All right, so like last week, there's one member that's actually comparing the Transact data feed to the Rhythmic data feed, and he's running breaks only on both. And last week he was just over $500 net on the Transact data feed using breaks only, and the prior week it was better than that actually. And so, okay, that looks like that seems like a very reasonable response to higher volatility. Either stand aside or just go to a reduced set of codes that are we have used in the past when things get really volatile. All right, so we've got there's two things here. The normal thing that I use, which is moderately aggressive plus breaks, and breaks only. Okay, now the green highlights in this E column were the cases where the break only did better than the moderate plus break, and I was curious to see if there was an obvious correlation to the overnight range. That's why these are orange. I'm just identifying the overnight ranges when break only did better than moderate plus break. All right, there isn't. I don't see an obvious correlation. All right, about the times when I would expect it to be better would be on all these red cells when the overnight range is greater than 100 points. And it's, half of them, that's the case. The other half, it's not. All right, so I don't see an obvious, it isn't quite as simple as I may have liked. All right, so then what we did over here is we just take our different categories and break them out separately to look at them. Okay, so what's currently highlighted is the results when the market overnight range was less than 60 points, and then between 60 and 100, and then over 100. Okay, now the key thing here is to look down at these two rows. All right, so over the past 28 trading days, 9 of the days have been less than 60, only one of which was less than 40. That's this one right here. 11 were between 60 and 100, and 7 were over 100. Okay. Now, it's important to note here, before we go any further, that for these cases here in the past, I would not have traded at all as a discretionary trader. That's too aggressive, or we would have been so super careful. I mean, the normal rules were choose a direction, only go in that direction, only do breaks, only do one trade setup, and even then we would be really careful and maybe not even do it. All right, so that's the world we live in right now until things go back to normal. All right, now, having said that, you'll notice, so it's kind of about the same. 9 less than 60, 11 between 60 and 100, 7 over 100. But what I want you to notice is the max loss days. All right, and this number makes sense to me. All right, there's the max loss days, and then what's the percentage of the time that you're hitting a max loss day when the overnight range is in this category. Okay, so, and what you see is really sort of what you would expect, that the percentage of the time that you're taking a max loss goes up as the volatility goes up. Okay, so it goes from 11% to 36 to 57, and that's in line with what I would expect. All right, now we don't have a whole lot of data here. It's only 28 days, but it's all we have to work with. So this is what I'm using to make some decisions. Okay, but this at least makes sense to me. This is exactly what I would expect to happen as the volatility goes up. Your likelihood, the randomness goes up, so the likelihood that you get whacked goes up. All right. So with that in mind, let's go back. Let's go back now and look at sort of each category. All right. You have in the less than 60 point arena. One way to look at this is if I chose to only trade this day, I didn't trade the other days, how would you have done? Okay. So, and this is across 5 weeks. All right. So you have to like what you see, because 2390, this is gross. 2390 on a 5K account that's pretty good, actually. All right, even the break only is a very reasonable return in terms of your the amount of capital you're allocating across that time period. All right. If you go to 60 to 100, you can see the change now in that the likelihood that you're going to take a max loss triples. All right. And the profit the system generates or the approach generates doubles. Okay. So you're going to have more days where you just get whacked. But the opportunity is there. Breaks only. This looks like a very reasonable approach to me. What I find interesting is that the actual number of days that you take a max loss on breaks only is higher in here than if you do moderate plus break. And so what that means is that your other trades that are in the moderate group are making up for, you're either in the trade already, so you're not taking a break trade that doesn't work out, or it's making up for break trades that aren't working out. All right. If we then go to more than 100 points, it's basically a coin flip, right? You have seven trading days here. 4 of them you're taking a max loss. The days you're not, you're doing really well is the thing, and so that's why it's tempting to do it. Okay, so that's what you would expect, right? There's a lot of movement in the market. There's a lot of opportunity to catch that 20-point run or that big run, and so if you're willing to participate, it's worth it in that respect, right? In that as a human, I couldn't do it because I can't react quick enough, and if particularly in those cases where you need to get right back into the market. All right. So my takeaway from this is that if I did nothing else but just looked at the daily range and adjusted the model build accordingly, and then just traded this column, which is moderate break plus aggressive when the overnight range is less than 60 points, I'm going to be pretty happy as a trader. All right, if I only did that. Okay, it means there's a lot of days. If you look at this here, there's a lot of blank space here. There's a lot of days where I'm not doing anything. Okay, and so it kind of depends on your personality. Some people that they're not willing to do that. They sit down, they want to trade. Okay, that's fine. But you can see my point is that previously, when we saw the volatility go high, we would just not trade. As humans, we just wouldn't do it. When the overnight range got above 60, we would just not trade. So it would be the same as what you're seeing here. So if I want to, where I'm going with this is, if I want to compare how the machine learning system performs to me as a discretionary trader, then this is the best way to compare it is to just look at this result here. Because when it's greater than 60 points, I basically am not trading as a human discretionary trader. Okay. And I like what I see here. All right. And this is in volatile times with a model that understands, okay, things are more volatile, so build the model accordingly. All right. So that's something to be thinking about. You have to make that choice every day, but would be perfectly reasonable to, if the markets are, if the overnight range is greater than 60, don't trade it. And if it's less, go for it. And we have, it's a reasonable amount of data. It's not huge, but it's not tiny either. We're not making a decision here on 4 data points. There's 28 trading days there. It's fairly representative in that there's, about a third. And so that would be a reasonable strategy, okay? When I look at the next category, what you see is your tolerance for taking a max loss is now a factor, regardless of what the end result is. If you're the type of person that you get two or three days in a row of getting whacked, then you basically shouldn't be doing this. All right. Even if you drop to break only, if you look at it, what the data shows is that's worse than just going for it. All right. So that's something to think about. I have a really high tolerance for, to me, it's $150. It's not that much, and I take a longer view. But people that are newer to trading or newer traders really struggle with that, and so you've got to make a choice. Do you want to be in this category where you may not be trading as much as you like, but your probability for getting whacked, especially whacked early, is what we're seeing, goes down. Okay, and then when you get to more than 100 points, this I think is basically just gambling. All right, it's a coin flip. It's not gambling because we have really strict rules about how much we can lose, but I don't see an edge here. Is my point. There's a very clear edge when the market is trading at when the overnight range is less than 60 points. It's very obvious to me. Here, I think it starts to become a little questionable because it's really easy to get, if a third of the time you're taking a max loss, it's easy to get 2 or 3 of those in a row when it's a third of the time, and then you're done for the week. You should be if you're following your business plan. All right, and when it's more than 100 points, it's worse, right? It's more than half the time you're getting whacked, and it's generally you're generally getting taken out right away. All right, and so what the conclusions that this led me to are here. All right, I can send this spreadsheet out actually to all members, so you don't need to worry about that. This is the T45 model. T means target. 45 means the target I used when I trained the model. Okay, and so again, just to be clear, where did this go? When we're at sort of normal volatility, when the sort of average overnight range is less than 40 points, I'm going to build the models with a 30-tick target, like we've been doing, and we have the data that shows what those, how that replays, how that trades out in normal times. And when the volatility is above that line, I'm going to build the models with a target that's further out. Okay, so basically we're just recognizing that the markets are making bigger moves, and so move the target further out. Otherwise, we're getting hurt in the noise is the problem. There's a lot, because there's a lot more movement. There's a lot more noise in the signal. So we're trying to filter out some of that noise. All right. The other parameters are that the noise filter is 4. The limit entry offset is 1. The max loss is set to 115, which means your max loss will be $160. And then a 635 start. These are the parameters for these results here. Okay. All right. So what I just described for model building, when the average overnight range is 40 points or less, then I'm going to build a model like I have been, like I developed the system around. All right. And when the average is higher, I'm going to build a model that's using targets that are further out. All right. there's a big difference. It doesn't look like a lot. It's only 15 ticks, but it's a lot in terms of the difference between these models when you run them in this environment. Okay, it makes a big difference. You take a lot less trades with that T45 model. All right, you're a lot more just. It's a lot more strict in terms of when it's going to issue a prediction. So Robert's saying, well, if it's more than 60 points, switch to a different market. I like that idea. Okay, Robert's specific suggestion is CL. I have not been able to give CL the attention that I feel like it needs to figure out how best to trade it in its current sort of quiet mode that it's in. But I agree with you. On these days here, the approach to take, I think, is when it's like this, on these days when you're not going to run the system, is there another market you can run instead? Yes, I like that. I like that general strategy. Okay. I personally am willing to do the blue category. I'm really starting to question the red category. All right, and so you'll see what I've decided that I'm going to do. So I'm going to share that with you, and then you can make your own choice. So model building, this is completely under my control. I'm going to build a model a certain way. You need to understand that, okay? But you can't do anything about it, right? But daily trading is different. You have to make this choice as a trader every day. All right, this is what I'm going to do. All right, so if it's less than 60 points, which is the yellow category, then I'm going to start at 635 and do moderately aggressive plus breaks, just like I've been doing, and I'm going for it. And you can see why. There's a very, very logical, rational basis for that choice. Okay, you take a lot less max loss days. Your profit potential is sound, and then you just might have to deal with not trading as often as you'd like. All right, this is a psychological issue for a lot of folks, this area, because they want to make money, right? I want to make money today. That's an issue that you're dealing with. All right, it comes back to you got to looking at it through a longer time frame. All right, if it's between 60 and 100 points, I personally am going to go for it. All right, but I'm going to start later. This is something else that came up just from member input over the last few weeks. Their results when they start later. So this is my current choice here. All right, between 60 and 100, I'm going to go for it, understanding that I got a higher probability of getting whacked. But I'm going to start a little bit later to let the markets settle down a bit. All right. That may not be the best choice for you. Okay. You may want to do in this category what I'm about to suggest for the next one. Okay. So if it's over 100 points, then what I'm going to do kind of depends on how the week is gone. If I'm down for the week, I'm not going to trade it if it's over 100 points because that number is too high. The likelihood that I'm going to take another max loss is just way too high. If I'm already down, 2 or 3 max loss days, then I'm not interested in it. The risk is too high. Okay. But if I'm up, then the choices are we'll stand aside or go for it because it's the same thing, right? The profit potential is big. All right. The likelihood you're going to get whacked is also high, but if you don't, that's 20% return on capital in a single day. That's the reason you would go for it. Okay. It feels a lot more like I said earlier. It feels a lot more like gambling to me now because there's really no edge there. You're just taking a chance, I think. All right. Here, very clearly, you can see the edge. Here, less so. It's getting a little blurry now. You are more likely to to get taken out of the market. All right, but you're also more likely to make more. Okay, so that's a reasonable choice. But look what happens here. My computer messed up here. So it's more volatile, but I'm making quite a bit less than on times when it is less volatile, right? And I have a much higher chance of taking a max loss. So this starts to seem not worth it to me. All right, I'm sure you can see that logic. Oh, I see what's going on. Hold on. This is trying to connect, and it's messing me up. Here we go. So you see the point is that I can see here the relationship between the likelihood that I'm going to get just destroyed versus my profit potential has now gone negative over here. And so that's the part that has me thinking, well, you're better off just standing aside. It's just not worth it. That's like a carrot that's out there, or the jewel of the Nile that you're chasing. But the reality is, just I think from a rational view, these days you're better off doing nothing. Okay, so recognizing that you may want to go for that, this is the way to think about it. I think if you're up, maybe go for it. If you're down, in fact, I think just saying it again out loud, I really think you ought to just stand aside if you're down for the week. All right, because again, look at the potential. It's just not worth it. Your potential's 490 across 8 trading days, but half the time you're getting whacked. It just doesn't seem worth it to me. All right, it's either go for it or don't. And if you're down, I think you ought to just stand aside. So actually, I just made that decision. That's what I'm going to do. So if I'm down for the week, then I'm just not going to do it. I'll move it into sim, and to Robert's point, I'll find another market to trade that day. All right. If I'm up, I got to make a choice. Stand aside again because of this relationship. It doesn't take a genius to see that there's a much higher probability I'm going to lose money than when the volatility is lower, and the amount I make is less overall. Okay. All right. So I'll send this out, and I'll if I have time, I'll try to kind of type this up nicely in the email so you can maybe print it out and refer to it to help you as you make your choice every day. But with that in mind, let's talk about what's the model going to look like this week. What am I going to do for the model? And then let's go over user-defined behaviors. Okay, so let me save this here. The thing that I've been working on from a modeling perspective is recognizing that this is a problem for the model because it's basically injecting randomness into our training data, and it's corrupting the result. And we see that very clearly by comparing models built here to models built here. All right, so that's what I did. I took the model that even it was more in here somewhere, built through there, and then I compared a model that was built with data before all this volatility hit for this period of time. This period of time, and the model that doesn't have all that randomness in it or that high volatility in it does much better. Not just a little bit better, a lot better. Actually, the period was it was here through the 9th. So these models were in competition. The one built through the second and the one built afterwards. All right. So what does that mean for moving forward? I started experimenting with how to automatically sort of filter out these days. I want to take those days out of the training data. Okay. Now I don't have a good automatic algorithm yet. All right. So I'm not happy with that algorithm. It just needs more. It needs more testing. And the problem is that the cycle of building the model and testing it is so long that it takes a while to iterate through it. So my first attempt was actually what I did was I took the I don't have a good picture of it here. If you have just a distribution of the range, and you look at it like you would expect to see something. Here would be a normal distribution. All right, and then there might be some tail like this on both sides. And the idea here is that and because of this high volatility, you'll end up with something like this out here. And the idea is to figure out, well, where is that point? And then cut that off, cut it out of the data. What I did was in my first attempt, I actually did something more like this. I cut it off like there and there. I thought, why don't you just take this idea and apply it on both sides and just grab that middle piece? And it turns out that that's not that good. It doesn't do as well as just my 0202 model. So this is like the model that's built with all the data through February 2nd is sort of the model to beat right now. And so this particular idea either is not sound, or the places where I chose to cut it off were not correct. And it's difficult. You basically just have to experiment. And so I'll be working on that through next week. Basically, I can get sort of one testing cycle in per day and a half, given how long it takes to build the model. So you take what happens is you decide what data you're going to exclude, and then you gotta pre-process the data, train the model. That takes a really long time, and then test the result, and based upon the result, do your next iteration. All right, so eventually we're going to get to a point where it's just sort of automatically figuring out what we need to exclude. But in the meantime, what are we going to do? So for Monday, what are we going to do? Our choices are just use the February 2nd model. That would be a perfectly reasonable choice. All right, because when you think, if you think about it, the results I'm showing you, all right, are for this model running on these days. What happened? Suddenly I can't draw now. Okay, well, anyway, so suddenly it is, or rather, the model that we have is running on, on data built through the 2nd, and it's running, we're running the tests for March 9th forward, okay? And one of the things that we talk about is we want more as current a data as possible in the model, okay, which logically makes sense. But when you think about how we analyze things, you can see that that's not necessarily better. Or rather, I test my models on a 3-month time period. So I'd build a model through September and then test it on October, November, and December. So if you think about that, the further down in time you go, so as we get into November, December, that model is now what, 6-8 weeks old in terms of how current the data is. So it's not necessarily terrible, right? So some of the reason I'm pointing it out is that some of the reactions I get from people are like, no, you have to include the data from the most recent week. And it's not actually the case when you think it through. If the patterns of the data are repeat over time, then you don't necessarily need a weekly update. And certainly what I'm seeing now is that because the volatility's increased so much, we're actually corrupting the model. So here's my plan. All right, I have a model through. Oh, now I can draw. I have a model through the second. All right, I'm going to build a model that includes data from these days and maybe these here. Okay, I'm going to put that data in and train the model. Okay, and publish that and run with that next week. I'll probably what will actually happen is I'll do that. It won't come out until tomorrow afternoon, and then on tomorrow night and Monday I'll run a test comparing those two and see did I improve the model or not? Did I damage it? Actually, that's what I want to know is did I damage the O202 model? Because if the reality is this volatility is still pretty high relative to what we've been doing. Okay, but this is what I'm going to do. The O202 model is up on the site. You can use it if you want already. You can just download it. But I'm going to create a model that's got this, less volatile times in it. All right, train that, publish that. I'll almost certainly run with that on Monday because I won't have time. I won't have had time yet to do the testing between the two. And then I might send out a message Monday night that says, hey, the testing shows that this new model sucks and we should use the old one. We should use the O202 model. Okay. I wasn't calling for a vote, but I'm certainly interested in your opinion. So Russell says, don't even bother. Just keep running with the O202 model until things settle down. That's a very reasonable thing to do. You can make that choice yourself, Russell, because the model is up on the site. Let me show you where it's at and make sure that I'm correct. It's possible that I'm not correct because I've got so many balls in the air right now. Let me log in. So if you go into models, there's the name of this file is not very smart. But this is the file that's got the O202 model in it for NASDAQ. Okay. You also have one that's got the December 7th for those of you that wanted to do testing for like under normal times. The name here, this zip file, is not right. This contains the model and the normalization factor file in it. So I'll change that. So that's going to cause some confusion, I'm sure. Okay, so what you're going to see Sunday evening is all markets for 1207. That's just going to stay there. This one's going to stay here, but it'll have a better name, though it's the same. The data itself won't change. And then there'll be a new one that's Rev 55. It'll have Friday's date on it, and it's going to have the O202 data plus some data in between. I'm gonna go look at these days and decide which ones to specifically grab. I'm gonna customize it. All right, until I have a model that'll just do that for me automatically. All right, until I'm comfortable with that algorithm. Okay. It's okay. That's a good question, Larry. Hang on. Let me make sure. I lost my. Here it is. Yeah, it's T45. Yeah. So the basic message is until we see this ADR come down to more normal levels, I'm building the models at T45 at target 45. Okay. So we can very clearly see the difference. I can bring that up real quick. Open. Here. Is this it? No, that's break only. Sorry. Actually, I don't know why I'm doing this. It's in the spreadsheet already. Hold on, it's right here. I grabbed the wrong one. That's what this is, or this here. That's the 0202 model on March 9th through current. All right. So what I don't have up there is the 1207 model on December and January, which shows. It basically shows December as flat and then January really good. Is kind of how it works out. I have that spreadsheet somewhere. Everything's done with these parameters, Jim. It's done with a noise filter of 4. Limit entry offset of 1, max loss of 115, which means you could lose 160. All right, and then 635 start is what is these tests are run with that. Okay. All right. So I'll get the model going here, and then I'll send out when I send out the notice that hey the model's been uploaded. I'll include this spreadsheet. And a summary of these rules here, these guidelines. Okay, so Philip is suggesting that including some of the data from the recent crazy markets is a good idea. And you each can make your own choice given that both models will be there. The only problem is that when I publish the file, it has in it. Well, let me do it this way. It has in it a config file. It has this file in it, and if you're not familiar with how to change that could be a problem for you if you want to change it. All right, so I'll publish it with the current latest model that includes data from these yellow rectangle areas here. But if you don't want that, then you're gonna have to go update that log file, that config file yourself. Okay. Yeah, this is using 10 tick stops. Oh, I'm sorry. I see the question now. Yeah. This is 10 tick stops. Okay. What we found is that certainly in the current volatility, 20 tick stops are not a good idea. You just end up losing more. It's too unpredictable. There's because these percentages are high enough that you end up just getting whacked. I think once I get a little more time, I'll do a little bit more analysis on 20 tick stops versus 10 tick. Most people want to use the tighter stop, so if you're able to do it, you're going to want to. And if you're able to do it with this kind of percentage on max loss days, then there's no reason not to. Okay, there's no reason to risk more. Okay, so now with that decision made, let's talk about the other thing that's been going on here. That we're getting short on time here. Currently, what happens is the system sends data to the server. That's this guy over here, this one. All right. And the server has code running that says, okay, yeah, I see the behavior that Shane has defined, and if I see that, when I see that behavior, I'm gonna send out a prediction. That's what's happening right now. And those behaviors are the turn as I've defined it, the pullbacks long and short as I've defined it, and the breakout as I've defined it. Okay. And one of the things I wanted to do was enable it so that anybody could call for a prediction for any of your own strategies. So what I mean is that right now you have no choice on when the system will say, yeah, I need to make a prediction here. Like the system's gonna make it's gonna make a prediction on that bar. That's a turning behavior that I've defined. Okay. You might think that's stupid or not appropriate for the market that you're trading. You may have this awesome strategy you like to use, and you'd like to get predictions for when the criteria define that you should enter the market. So it's actually one of the things that that the machine learning taught me is that I may think that this is a trade setup to get long, and then so I said, okay, when I see that trade setup to get long, make a prediction, but the prediction comes back to get short, and it turns out that that's a really good thing to do. All right, so anyway, the point is that if you have a strategy that you want to use, you don't have a way to get a machine learning prediction for it. You can only get a prediction on bars where I've defined the behaviors. All right, so I want to change that. And so I've updated the custom study so that you can define when to call for a prediction. All right. And if we look at the study here, this is the updated study. There's two new settings. Okay. Michael, I'll answer your question in just a moment, okay? So the first one is, do I execute a prediction for a user-defined behavior, yes or no? And if the answer is no, then this is just what the system does what it normally does. Okay, so the default is no. When I publish this DLL, you won't see any difference in the current behavior of the system that I've built here. Okay. But if you want to create your own strategy and ask for a prediction from the machine learning system, you can do that. You will be able to do that now once I release this. Okay. And you do that by changing this to yes, and then what you have to do is define a color bar by alert condition study, and when that study evaluates to true, the system will give you a prediction. Okay. And so what I've done here is, to demonstrate it, I have this, I set it to yes, and I have this this color bar based on alert condition study down here. All right, and then basically what it's doing is you're choosing the study, and then you're choosing the subgraph that will evaluate to true or false. All right, and then when this color bar based on alert condition is true, the system is going to give me a prediction. And the prediction will either be get long, get short, or do nothing. All right. And so by way of testing it, you can see I'm set up here now. Prediction for user-defined behavior is yes. This is the study to use. And what will happen is, as we replay this, when that condition is true, we'll get codes that are specific to that color bar by alert condition. Okay, so let's pause it right there. So what I did is the alert condition is stupid. It's almost random, but you can see you're getting the get long codes, 199, 199, 199. If it was a short, it would say 299. So those are your codes for user-defined behaviors where the prediction from the machine learning system is to get long. And if the prediction is to get short, then it would be 299. All right. Otherwise, it'll be 0. Okay. So some of you have, stuff you've been using for years. I would really encourage you to go test it out and see. Your system says to enter here. Your system almost certainly says enter here in a certain direction. Set it up so that you get a prediction and see how well it performs, and then just replay it. Okay. One of the things I'd like to do is create like a community download section where you have a particular strategy that you use that you want to share, and you give it to me and I'll vet it. I'll run some tests and I'll publish it for other people to take a look at and use if they want. Okay, so we're almost like crowdsourcing machine learning strategies in trading is the idea. So eventually we'll get there, but this is the first step. Is okay. Let's create it so that you can call for a prediction on any based upon a strategy that you've defined in the market. It will be available probably next weekend, Michael. So I have to do two things. I have to run this DLL live by myself to make sure that there's nothing obviously broken. Okay, there's also a server update that has to occur. All right, and I also have a bug in the server I need to fix. So I don't want to issue 2 server updates at once. That's painful. I don't want to issue 2 different updates. I'd rather do just one. All right, so I'm planning on releasing, and the problem with the server update is that the server and DLL, they have to update at the same time, so doing it midweek is difficult. So almost certainly it'll be next weekend. There'll be a new server, chart book, and DLL as part of the download. Okay. The other change I'm making is that we have figured out how to make the spreadsheet a lot more tolerant of people moving stuff around in the studies list. Okay, so that was a problem before where if you added something or moved it around, then the spreadsheet got screwed up. But in February of this year, Sierra Chart made it a little bit simpler. All right, the other thing I have to do, Michael, is I have to publish a video on how to do this, because how you would set it up yourself, because the ML Predict study is dependent on some of the studies before it, and so you can't just take ML Predict and put it on a chart and have it work for you. You have to have bid-ask order push, you have to have order flow, you have to have extended move reversal, and you have to have a bid-ask chart that's feeding this study, or it won't work. Okay, so there's a lot of little pieces there that have to be in place in order for you to actually get a prediction. Eventually, I'll put it all together into one thing, but I'm not there yet. All right, I'm not there yet. I won't be there until I'm comfortable that I'm done adding data that I'm to use. Once I'm at a point where I go, okay, I'm not going to add any more data to my prediction engine. So in other words, right now we're at Rev 55. When we get to a point where I'm not going to rev it anymore, then I'll change the custom study to be just one thing, and you put it on, and it's a lot easier to work with. As it is now, though, it's dependent on 3 or 4 studies before it plus another chart, and if they're not there, it won't work. Okay. It's the same DLL, Bill. It's the same study. It just has a new setting. Okay, so It's the TRTML predict study. All right, it's just that you have choices down here now that you didn't have before. If you look right now, you can see prediction for user-defined behavior. You don't have that. You will though. All right, currently it's either or. So if you say yes here, then it won't give you the rational trader prediction. It's going to give you your prediction. All right, it won't make a prediction on turning behavior if you put this to yes. All right, so you're able to do. You're basically completely. If you want to do them both, you need two separate charts. Basically, is where I'm going with that. It won't do. It won't do both in the same chart because I don't know what you're doing, and I don't know who's more important. All right. Okay, so lots of positive comments. And then there was another comment about models from Michael. Let me see what you say here, Michael. So Michael, that's exactly what I'm saying, is that when the volatility is high, I'm going to make a model a certain way. And then when the volatility is low, I'm going to make the model differently. Okay? And where exactly that line is, I don't know yet. But I can tell right now that I'm in the, if I just put a line right there, okay, I'm clearly in a space where I need models built using the higher volatility settings. So Russell is suggesting that in this system here, where we're adding the ability to do a user-defined prediction, that I just do both, okay? Do both rational trader predictions and user-defined predictions. I don't think that's a sound idea. First of all, what do you do when they're both calling for a prediction? What code do you output? It may not matter because the prediction is going to be the same, but which one has priority? It makes analysis difficult, because if your system is saying give me a prediction and so is the rational trader, then when you go to analyze your system, it's polluted. You can't tell. So I think to start off here, we should keep them separate. You are correct in that if they both ran, it's just a matter of adding 199 and 299 to this list. Yes, okay. But you're also making the assumption, Russell, that people are going to use the spreadsheet study, and they don't have to do that. You can just do your run your strategy, get your action code, and then do whatever you want with it. However you want to manage that, whether it's manually or you have your own way of executing automatically executing a trade. So certainly at the outset here, let's keep them separate. I'm looking at questions here. So lots of people like the idea of seeing other strategies. So we'll see how much traction that gains. I have to be careful with that just from a liability perspective, and so there will be what has to happen is you have to submit it to me, and then I will I'll have to vet it in some way. I'm going to want to use it and run replays on it, and with the with the chart book that has this strategy implemented in it, it needs to have sort of a spreadsheet with it that shows the replay results and things like that. It's very easy to get into trouble there. But I like the idea. Certainly, the reason I like the idea is that in general, I have learned so much from the people that I've interacted with over the years. Even though I'm supposed to be, I'm the educator, right? But the reality is that there's there's a lot of smart people out there with lots of good ideas, and I think the best solutions come from ideas from lots of different places that get put together and integrated into something that no single person had thought of. And so that's that's what could happen here. All right. And certainly you have other cases where you've got people that are more conservative, more aggressive, focused on different markets, focused on different time frames, things like that. It's stuff I don't have time to do or don't have an interest in doing, but others do. And let's share that. I really like that idea. I've just been watching over the last decade or so the different ways, the different things that we can crowdsource, and it surprises me what some of those things are. And so this falls into that category. So I like that idea. Okay, so a couple questions here. From Philip, is there a way to instruct the system to trade only short or only long if I feel the market has picked a direction? Sure, Philip, just take out the short codes or long codes from your spreadsheet. All right, so that, where is that? That's here. So in the spreadsheet, if you only want to get long, there should not be a single code here that starts with a 2. That's easy. Okay. How do we see the details of your models? I don't understand what you're asking, Jim. I'm telling you what I'm doing. The actual guts of a model are not meaningful to a human. I don't quite understand your question. I'm going to stop the recording now for this week and then work out this question with Jim, and then we're going to call it a day here.